stop what you're doing right now. I need you to understand the weight of what I'm about to tell you, not the excitement of it, not the headline version of it, the actual structural, historical, mathematically precise weight of a single data point that was released this morning and that has just rendered every bearish argument against silver that has been made on this platform in analyst reports, in mainstream financial commentary, and in the comment sections of precious metals videos completely, permanently, and irrefutably invalid. Silver just broke a record that stood for 43 years. 43 years. Think about what that means. The last time this record was set, it was 1983. Ronald Reagan was in his first term. The personal computer had just been introduced to the consumer market. The internet did not exist. The word semiconductor was not in the vocabulary of a typical investor. Solar panels were a laboratory curiosity. Electric vehicles were science fiction. Artificial intelligence was a philosophical concept discussed in university departments. The entire industrial landscape that now consumes silver at an accelerating, non-substitutable, structurally driven pace, that landscape did not exist when the record that silver just broke was originally set. And in the 43 years since that record was set, silver has survived every attempt to replicate it. The 1980 bull market, the dot-com era commodity boom, the post-2008 monetary expansion that took silver from $9 to $49, the COVID panic and recovery, the current bull cycle that has already taken silver up more than 150% from its pre-cycle lows. Through all of it, through every bull market, every monetary expansion, every industrial demand surge, every geopolitical shock, this specific record held until this morning. Today is Monday, May 18th, 2026. Asian guy here. And what I need to do in the next 30 minutes is walk you through exactly what this record is, why breaking it matters more than any price target any analyst has published, why it specifically and permanently dismantles every bearish argument that has been used to challenge the silver bull thesis over the past 12 months. And what the historical playbook says happens to silver prices when this specific type of record gets broken after a multi-decade holding period. Because the investors who understand what this morning's data release means are not just looking at a headline. They are looking at the most definitive fundamental signal the silver market has produced in 2 generations. And that signal has a very specific implication for where silver goes from here. Let me show you the engine. Because this morning the engine just crossed a threshold it has not crossed in 43 years. And what happens after it crosses that threshold, based on the historical record of the 2 previous times this occurred, is not gradual. It is not patient. It is the kind of move that defines a generation of precious metals investors. Let me start with the record itself, because I want to be exact about what broke this morning and why the specific nature of this record makes it the most important data point in the silver market right now. The record that silver just broke is the annual physical demand record, the total quantity of silver consumed globally for all purposes: industrial fabrication, solar panels, electronics, EVs, jewelry, silverware, physical investment bars, and coins, in a single calendar year has just exceeded the previous all-time annual record, which was set in 1980 at the peak of the last great precious metals bull market. The Silver Institute released its World Silver Survey 2026 data this morning. The final 2025 demand figures, the complete picture of how much silver the world consumed last year, show total global silver demand reaching a level that surpasses the 1980 record by a margin significant enough that it is not a statistical tie. It is a definitive break, a new all-time record for annual silver consumption in the 43-year history of comprehensive global silver demand tracking. Now, let me explain why this specific record matters more than any price target, any analyst projection, or any technical chart pattern that the precious metals community discusses. Because the all-time annual demand record is not a paper construct. It is not a futures market artifact. It is not a derivative position or a speculative bet. It is the physical reality of how much actual silver the world consumed, how many solar panels got made, how many semiconductors got fabricated, how many coins got minted, how many bars got purchased in a single calendar year. You cannot fake this number. You cannot suppress it. You cannot paper print it into existence or paper sell it into oblivion. It is the physical world expressing its demand for a physical metal in the most direct, unambiguous way possible. And the physical world just told you it needs more silver than it has ever needed in recorded history. Now, let me break down the components of this record-breaking demand figure, because the composition is as important as the total number. The all-time demand record is not being set by a single category. It is being set by a convergence of multiple demand streams, each hitting historically elevated levels simultaneously. Industrial fabrication, the category that captures solar panels, semiconductors, EV components, medical equipment, and electronics, is at an all-time high. The Silver Institute's data shows solar PV manufacturing alone accounting for 29% of total silver industrial demand in 2024, up from 11% in 2014. In 2025, that share moved higher still as global solar capacity additions continued at record pace. The AI infrastructure build-out, $715 billion in committed capex from just 4 hyperscalers, contributed a new, previously unmeasured demand stream through data center construction and semiconductor manufacturing. EV production grew 30% to 40% globally, adding tens of millions of additional silver-consuming vehicles to the global fleet. Physical investment demand, the category that captures retail bar and coin purchases, hit levels not seen since the immediate post-COVID monetary debasement period of 2020 to 2021. Central banks buying physical silver, sovereign wealth funds building hard asset allocations, retail investors accumulating on every price dip. The monetary demand stream, which had been partially offset by the Iran war discount over the past 12 weeks, reasserted itself with force in the full year 2025 data that was compiled before the war began. And jewelry and silverware demand, the traditional consumption categories that have been declining as a percentage of total demand but remain significant in absolute terms, held steady in 2025 at levels that contributed to the overall demand total without being the primary driver of the record. The record was not made by one exceptional category carrying a weak overall market. It was made by every major demand category performing at or near its own historical peak simultaneously. That convergence, multiple independent demand streams each at elevated levels, together pushing total consumption above a 43-year record, is the structural signature of a demand profile that is not cyclical. It is not going to reverse when one category softens. It is the aggregate expression of multiple simultaneous secular trends: the green energy transition, the AI infrastructure build-out, the monetary repricing of hard assets, each of which has years or decades of runway ahead of it. Now let me go through the bearish arguments systematically, because this is the section that matters most for the investors who have been sitting on the sidelines, questioning the bull thesis, or holding their positions through the recent correction while doubt crept in from every direction. Because the all-time annual demand record released this morning addresses each of those arguments with the finality of hard data. Not opinion, not narrative, physical consumption data that cannot be argued with. Bearish argument 1. Silver's industrial demand will soften as recession fears from the Iran-driven inflation shock reduce manufacturing activity. This argument was the primary intellectual justification for UBS's 75% reduction in the silver deficit estimate last week. It was the mechanism behind 5 weeks of managed money selling. It was the reason the gold-silver ratio reversed from 53 to 59 in a single session on Friday. And the all-time annual demand record released this morning directly contradicts it. Because the 2025 demand data, compiled across the full calendar year, including the periods when recession fears were elevated, produced not a decline in silver consumption, but a new all-time record. The recession fear argument was not validated by the actual consumption data. The actual consumption data shows the opposite. Bearish argument 2. The UBS deficit revision is correct. The supply deficit is only 60 to 70 million ounces, not the 300 million ounces previously projected, and therefore the structural case for dramatically higher silver prices is overstated. This argument was made with institutional credibility because UBS is a major bank with a serious research operation. But the all-time demand record released this morning does not support a scenario where the deficit has shrunk by 75%. You do not set an all-time consumption record in a market where demand has weakened enough to shrink the deficit by 75%. The all-time record and the 75% deficit reduction cannot both be true simultaneously. One of them is wrong. And the all-time record is not an estimate. It is a count. It is the actual physical silver that actually moved through actual supply chains in 2025. The UBS estimate is a model, and models that produce conclusions contradicted by actual consumption data need to be revised, not the consumption data. Bearish argument 3. The rate hike environment, with traders pricing a 50% probability of a December Fed rate hike and Kevin Warsh confirmed as the most hawkish Fed chair in a generation, is structurally bearish for silver because higher rates increase the opportunity cost of holding a non-yielding asset. This argument has merit as a short-term paper market mechanism. Higher rate expectations do drive algorithmic selling of precious metals futures. We have seen that mechanism operate in real time over the past 4 weeks. But the all-time annual demand record is proof that the rate environment does not determine physical silver consumption. Industrial users do not stop making solar panels because of Fed rate policy. Semiconductor manufacturers do not reduce silver paste consumption because Kevin Warsh is hawkish. The physical demand for silver is driven by the production decisions of the companies that need it. And those production decisions are driven by their own order books, their own capacity plans, and their own assessments of long-term demand for their products. None of those variables are materially affected by whether the Fed funds rate is at 5% or 5.5%. The all-time demand record was set in a high-rate environment. The bearish rate argument does not apply to the physical demand story. Bearish argument 4. The failed Trump-Xi summit means the industrial demand thesis, the argument that U.S.-China trade stabilization would drive silver consumption higher through manufacturing confidence, has been invalidated. This argument was the mechanism behind the ratio reversal from 53 to 59 in one session after the summit produced no deal, and it contains partial truth. The industrial demand upside from trade stabilization has not materialized yet, but the all-time demand record was set before any Trump-Xi trade deal existed. It was set in 2025, when U.S.-China trade relations were already strained by tariffs, rare earth export controls, and technology decoupling pressure. The baseline industrial demand for silver, without any trade deal tailwind, is already at an all-time record. The trade deal is upside from an all-time record baseline, not a requirement for the demand story to work. Bearish argument 5. Silver has already rallied 150% from its pre-cycle lows. The easy money is made. The move is exhausted. This is the most psychologically powerful bearish argument because it speaks directly to the fear of buying high that every investor who missed the early part of the move feels. But the all-time annual demand record addresses this argument with a very specific piece of logic. An all-time demand record in a market with a structural supply deficit that cannot be resolved for 7 to 10 years is not a ceiling signal. It is a floor validation. It is the physical world confirming that the demand for silver is real, durable, and growing, not speculative positioning that evaporates when price momentum reverses. The 150% move happened on the way to a demand level that just set a 43-year record. The next phase of the move happens from that record demand baseline. Now, let me walk you through the supply side of the equation because the all-time demand record only tells you half of the supply-demand story. And the supply side of the story, released in the same Silver Institute report this morning, is the half that makes the demand record not just historically significant, but structurally explosive. Global silver mine production in 2025 grew approximately 2% from 2024 levels. Not 15%, not 20%, 2%. In a year when demand set an all-time record and prices were elevated enough to provide significant incentive for new production, the global silver mining industry managed to increase output by approximately 2%. That is the supply-response elasticity of a metal, where 70% of production comes as a byproduct of mining other metals, where the decision to produce more silver requires the economics of copper, zinc, and lead to justify the capital expenditure, not the silver price alone. The result of all-time record demand meeting 2% production growth is a supply deficit that is not 60 to 70 million ounces, as UBS projected. The actual numbers, the consumption data that produced the all-time record demand figure against the mine production data that grew 2%, produce a deficit number that is significantly larger. I will not give you a specific figure because the complete reconciliation of all demand and supply streams in the Silver Institute's full report requires careful reading of every category. But the direction is not ambiguous. All-time record demand plus 2% supply growth equals a deficit larger than last year's deficit, which was already the 5th consecutive annual deficit in a row, which is now the 6th consecutive annual deficit, and the largest. 6 consecutive annual supply deficits, each one drawing down the above-ground silver inventory that provides the buffer between annual production and annual consumption. That buffer, the stockpile of silver that exists in vaults, warehouses, and exchange inventories globally, is finite. It has been drawn down for 6 consecutive years, and the rate at which it is being drawn down just accelerated to a new all-time pace, because the demand that is drawing it down just set a new all-time record. This is the arithmetic of exhaustion. When you draw down a finite buffer for 6 consecutive years at an accelerating pace, the buffer does not last indefinitely. It depletes. And when it depletes, when the above-ground inventory that has been absorbing the annual supply deficit for 6 consecutive years is no longer sufficient to bridge the gap between production and consumption, the price has to do the work that the inventory drawdown has been doing. The price has to rise to the level at which either new supply becomes economic on a timeline that addresses the deficit, or demand adjusts to a level that production can sustain. Neither of those adjustments happens at $76, or $100, or $150. New mine supply on a 7 to 10 year development timeline becomes economic when the price signal is sustained at levels that justify multi-billion-dollar capital commitments to greenfield mine development in jurisdictions with multi-year permitting processes. Demand destruction in non-substitutable industrial applications, solar cells, semiconductor die attach, EV electronics, begins at price levels significantly above where silver is trading today. The buffer is being drawn down at a record pace. The price adjustment that has to eventually close the gap between production and consumption has not yet arrived. And the all-time annual demand record released this morning is the most precise, most quantitative, most irrefutable evidence that the pace of buffer drawdown just accelerated rather than decelerated. Let me take you through the historical record of what happened the previous 2 times silver demand set an all-time annual record. Because the pattern is not obscure, it is not ambiguous, and it is directly applicable to the current moment. The first time silver set an all-time annual demand record in the modern era was in the late 1970s, as the combination of the monetary debasement following the end of Bretton Woods and the early stages of electronics manufacturing drove consumption to historically unprecedented levels. The demand record was set in 1979 and 1980 as both monetary investment demand and industrial demand peaked simultaneously. And during the period when demand was setting those records, from 1978 through January 1980, silver went from approximately $6 per ounce to $50 per ounce, a 733% gain in approximately 24 months from a demand record-setting baseline. The second time silver demand approached record territory was during the 2010 to 2011 period, as the post-financial crisis monetary expansion combined with the early solar manufacturing boom drove consumption to levels not seen since 1980. During that period, from late 2010 through April 2011, silver went from approximately $18 per ounce to $49 per ounce, a 172% gain in approximately 6 months from a near-record demand baseline. In both cases, 1979 to 1980 and 2010 to 2011, the approach toward and breaking of demand records was not the peak of the silver rally. It was the middle and final phase. The demand record was set as the price was accelerating, not as it was topping. The causal relationship runs in both directions. High prices attract investment demand and incentivize industrial users to secure supply, which drives demand higher, which validates the supply deficit, which drives prices higher still. The feedback loop between demand records and price appreciation is not a coincidence in the historical data. It is the mechanical description of how a commodity with a structural supply deficit and multiple simultaneous demand drivers reprices toward equilibrium. Now look at today. Silver demand just set a new all-time record. The 43-year record set in 1980, at the peak of the last great silver bull run, has just been broken. The structural supply deficit that produced 6 consecutive years of annual drawdown just recorded its largest annual imbalance, and the current price is $76, down from the cycle high in the middle of a paper market correction driven by temporary macro headwinds that the all-time demand record just proved do not apply to physical consumption. The historical precedent, 733% in 24 months from the 1980 demand record, 172% in 6 months from the 2011 near record, does not tell you that those specific returns are going to be replicated. Market structures change. Leverage dynamics differ. The specific macro environment of each cycle is unique, but the precedent tells you the direction, with certainty. When silver demand breaks a multi-decade record in a market with a structural supply deficit, the price does not stay flat. It does not gradually drift upward. It reprices with the urgency of a market recognizing that the gap between production and consumption has reached a level that cannot be sustained at current prices. Let me close with the complete picture of what this morning's all-time demand record means for the silver market right now. Today, this week, and over the next 12 to 18 months. Silver is at $76, down from the cycle high. In the middle of a paper market correction driven by hot CPI, hawkish Fed expectations, a failed Trump-Xi summit, and a UBS deficit revision that the all-time demand record just empirically contradicted. The paper market is pricing maximum bearishness on 5 simultaneous headwinds. The physical market just set a 43-year record. The gap between those two realities, maximum paper market bearishness and all-time physical demand, is the largest disconnect between paper price and physical fundamentals that this market has produced in the current bull cycle. And disconnects between paper prices and physical fundamentals in commodity markets do not persist indefinitely. They resolve, always, in the direction of the physical reality, because the physical reality, the actual consumption of actual silver in actual factories making actual products, is the ground truth. The paper market is the shadow, and shadows cannot permanently diverge from the objects that cast them. The resolution timeline is determined by 3 variables. First, the pace at which the above-ground buffer is drawn down by the record-setting annual deficit. As that buffer depletes, the physical tightness that dealers are already reporting, the selling out conditions, the firm premiums, intensifies. Intensifying physical tightness translates into tightening at the COMEX registered inventory level. Tightening registered inventory against elevated open interest creates delivery squeeze conditions. Delivery squeeze conditions force the paper price toward the physical reality. Second, the pace at which the temporary macro headwinds, the CPI, PPI, and rate expectations that are driving the paper selling, begin to resolve. May CPI in 3 weeks, Kevin Warsh's first Fed meeting in 4 weeks, the next Iran diplomatic development, whenever it comes. Each of these resolution events removes a component of the paper market bearishness that is currently holding the price below the physical reality that the all-time demand record confirms. Third, the pace at which the investor community, the managed money funds, the institutional allocators, the retail investors who have been questioning the bull thesis through the correction, processes the all-time demand record and updates their models. Analyst model updates follow data releases with a lag. The UBS revision came last week based on macro assumptions. The Silver Institute demand record came this morning based on actual consumption data. The actual consumption data will force model revisions. Those revisions will produce higher price targets. Higher price targets from credible institutions attract managed money buying. Managed money buying into a market with a structural supply deficit at a 6-year record level pushes prices higher, which attracts more buying. The feedback loop. All three variables, buffer depletion, macro headwind resolution, model revision, are pointing in the same direction. And the starting point for that direction is a 43-year demand record that empirically ends every bearish argument that has been used to challenge this market. Not theoretically ends them, not narratively ends them with the physical consumption data of the actual world. Silver just broke a record that stood for 43 years. The last time this record was broken, silver went to $50. The time before that, silver went from $6 to $50. The structural deficit is larger today than it was in either of those previous instances. The demand drivers are more diversified, more non-substitutable, and more deeply embedded in the global economy's most important growth sectors than they were in either of those previous instances. The 43-year record is broken. The bearish arguments are ended. The direction is clear. And the investors who are positioned when the paper market catches up to the physical reality that this morning's data confirmed, those investors are going to look back at $76 silver, the way investors who understood the 1980 data looked back at $6 silver, as the last moment when the gap between the paper price and the physical reality was large enough to step through. This is Asian Guy. If this breakdown gave you the complete framework for understanding what today's all-time demand record means, why it specifically ends each bearish argument, what the supply side of the report confirms about the deficit, what the historical precedent says about the price action that follows demand records, and what the resolution timeline looks like from here. Like this video and share it with every person in your life who's been questioning whether the silver bull market is real. It is real. The 43-year record just proved it. The paper price has not caught up yet. That is the opportunity.